Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We appreciate it. Real quick before we get started here, we are in the process of gearing up for our mastermind meeting of the Inner Circle. It is happening in Dallas in early May. If you are interested in looking into that meeting and joining the Inner Circle, go check out Hard Money Mastermind innercircle.com. Okay, today we're talking about refis, refinance lending. So a lot of our business is focused on acquisition lending for sure. There's a lot of fix and flip in there. Sometimes there's just straight acquisition loans, but there are opportunities in refinances if you know what you're doing to lend against a property that somebody already owns. And the scenarios can vary a bit. That's why we're going to talk about some of the risks. Like just because it's a fine LTV doesn't mean you have no problems. You know, there's more factors that we're going to break down today.
Yeah, absolutely. And you know, I heard the argument years ago from some OG private lenders that they don't lend on refinances. They only do purchase and renovations. They would never lend on refinances. And I didn't fully understand why. But I will say that there's more risks in refinance lending, and there's more due diligence that you have to take into consideration. And like what Chris said earlier, you know, just because someone owns a property free and clear worth $100,000 and they want to loan a $50,000, hey, on paper, that makes sense. But as you dig in, there could be a lot more hair on that deal that you got to look out for. So let's go through some of that stuff. Like, number one, you got to determine what the cash is going towards, right? If you can't just give somebody, let's say they have a property worth $100,000 and they want $50,000, you can't just be like, cool, let's do a loan for $50,000. You'll net that, you know, whatever they net after fees. Like it, you gotta determine what that cash is. Number one, you got to make sure that it's, you know, on your end, that it's something that you're comfortable giving them the funds for. And number two, it's got to be a commercial or business purpose proceeds. You can't take out $100,000. Like, you can't do a loan to a real estate investor who owns a rental property free and clear, and you can't give them $50,000 cash out for them to go pay for their kids' school or to pay off personal debt or to do anything personal. That's considered a consumer personal loan, right? So that's like 101. You got to be careful by doing some. They got to document it. Typically, we have a use of proceeds form that they fill out. Yes, they're filling out commercial purpose affidavits and things like that at closing, but it's up to you to do whatever due diligence you can. But more importantly, like, you don't just want to give somebody cash out of a property for with no purpose in mind. You got to figure out what that purpose is. So also you got to think about exit strategy. So on a standard deal, if you do a loan for a real estate investor that's buying a property to fix and flip, their goal is typically to sell the property. That's the exit strategy. Or maybe refinance the property if they're going to follow the BRRRR method. And that's the exit strategy. But what happens if you do a loan, $100,000 again, $100,000 free and clear, they want $50,000. They have a tenant in there paying, you know, $1,000 a month. Maybe they have good credit. Maybe they don't have good credit, and you just give them cash out. How do they plan to repay the property? Like, remember, if a borrower doesn't have good credit, they're not going to be able to refinance. Refinance is out. They can't do that. And if the property's occupied, they're probably not planning to sell the property. And so you really got to dig deep a little bit more on that extra strategy than other stuff. Another thing, and there's lots of, you know, risk. And again, I don't want to, you know, steer you away from doing refinances, lending. We do a lot of refinance lending. Just keep in mind that there's more due diligence that we're doing on these. But let's say a borrower buys a property in cash. Or not cash. Let's say borrows a property. It doesn't matter if it's cash or not. Let's say they borrow a property, and they buy a property for, you know, a small amount of money. They finance it. Let's just say they buy it for $50,000. They put $50,000 into it, and they get a loan of like $100,000 at the time, right? And then 2 years ago, and that, say it's, you know, the market's gone up a lot, and now it's worth like $250,000. Right. And it's worth a lot. Now, obviously, those numbers could be extreme, but but go with me. All of a sudden they come to you be like, oh, hey, I want to take, I do a loan of like 165, that's 65% of 250. It still meets your requirements type of thing. And then all of a sudden they're going to get cash out. Well, they've already gotten 100% from some, private lender at the beginning. The last thing you want to do is just give them cash out and liquidate their sweat equity on their deal. And then they have no skin in the deal, right? If you do a loan for somebody at the beginning, typically you're giving them, they're bringing cash to the table to begin with, so they have skin in the deal. You don't want to just give them cash out to give them cash out. So then, and they're just cashing out on sweat equity. Then they have no involvement in the deal. Nothing ties them into the deal. So you kind of have to look at it as like, hey, this is a really good deal, but like, how would I structure this if I was structuring this as a purchase to make sure that they had ample cash skin into this deal to prevent them from walking away?
Have you ever used that term before? Liquidate their sweat equity? That makes a lot of sense. I don't know if we've ever used that exact term, but
I don't know. When I was taking some notes on this podcast this morning, some ideas, I wrote that down. Like I have that.
Yeah, no, that's a real factor.
Sweat equity.
That's a good one. We're gonna have to remember that one. I wanted to drill down a little bit more on the refinance exit strategy because it's just so common that somebody's like, oh yeah, I own this property. It's a rental. It's worth $300K and I have tenants in there. Or whatever the situation might be. And, I want 50% of the value. It's worth $300K. Like, give me a loan for $150. And almost every time they're like, oh, I'll just refinance to pay you off. Whether they're able to do that or not, whether they're going to qualify for the refi or not, we don't know yet. But and sometimes it can happen for sure. I mean, oftentimes it can happen. A good way to check and see if somebody's going to qualify for a refi is whether or not they have institutional money or bank loans currently. They have a mortgage on their house, mortgage on a rental property. Maybe they used, Kiavi or somebody and got a DSCR loan on another property. Well, there you go. They can probably refi. If they don't have any of those things going on and you can tell in their financials and credit that it's a little bit shaky, you're not going to want to get into those deals because those are the ones that end up defaulting. Because if they, people get emotional sometimes about real estate, even if they don't live in it. And they'll say like, oh, I'm not selling. Well, that's a conversation we'll have up front too. We'll say, okay, we'll do this deal. It's 50% of the as-is value, our loan amount. If your refinance is not approved, you're going to have to sell. Are you willing to do that? And sometimes people will say no straight up. They'll be like, no, I'm not selling this. And then we're like, I don't know if we want to get stuck in this deal, which you will. You'll be protected by the equity, but it's going to be a headache. And some people actually do perform on that. Like, look, if your refi doesn't get approved, we have a situation like this going on in New Jersey currently where the borrower, she tried to refi last summer at some point. She didn't qualify for the refi. It was coming up towards the end of the term, and we had that conversation going in, and she respected that conversation and the fact that we agreed on it and listed the property to sell. And so be it. It's okay. Yeah, I just wanted to drill down a little bit more on the refinance exit because it's just so common for people to say that. And managing the defaults, managing the loan portfolio that's not performing is part of what I do every day. And there's definitely some refis in there, definitely some cash out refis that we're in a fine equity position, but we're kind of stuck until we can work it out via foreclosure or eventually get them to sell or something.
Yeah, you don't want to be stuck. You're doing short-term loans and for a purpose. And you want to make sure they have the means to execute. And I know that's hard sometimes. I mean, listen, there's loans that we've done. Borrower inherits a property worth $1 million. They need a loan of $100,000 to, in essence, renovate it and then turn it into a rental property. But they don't have great credit and they don't execute on it. Like, it's hard to say no to that deal, and you're not going to, in essence, lose money on that deal. But there's hair on that deal, and you got to be aware of it. So a few other key things, to make sure you're aware of. Is there's no after repair value on a rental property. And I'll explain and dig into that because I think that is a common misconception. But if a borrower owns a rental property free and clear and they're taking money out for whatever, to buy another rental property, to fix some repairs on the current rental property, to invest in a business, whatever they're doing, if there's a tenant in place living in that property, there's no after repair value. There's an as-is value or a nice livable property value. But there's not like a mapped out after repair value, fully staged, ready to go type of thing. And there's a big difference in values on that. So you can't base it off of after repair value. You have to base it on like, hey, this is a livable property. So it could be worth significantly less by doing so. When there's renters in place, there's no, think about it. You have two houses right next to it. One's a nice house that a tenant lives in. The other one's a fully renovated stage property. What's going to sell for more? And guess what? It could have been a fully renovated property, but the day that those tenants move in, that property is worth slightly less. Another thing to make sure to do due diligence on, and I know a lot of people will be like, well, I'll just rely on the title company for this, is to make sure that the owner is actually the owner of the property. Make sure, we like to look at public records and tax records to make sure that they're the actual owner of the property, how long they've owned the property. We're always pulling up public records and doing as much data resource that we can, not just on MLS, but on other, statewide tools as well, to make sure that we're actually lending to the right owner. In general, refinancing, it's a creative game. How do you structure these deals to make them work, that, you're still safe? You obviously want to limit your cash out that you're giving to them, right? You don't want to be used as like an ATM or a bank account for them. We've done that. We've been involved in those deals where real estate investors will own lots and lots and lots of free and clear real estate. And again, you do a deal for them here and there, and, to access cash for another business venture or something, it's okay. There's more gray area. You just got to make sure that they have an exit. And what you don't want to be involved in is a sinking ship, right? We're looking at this deal right now in Washington, D.C., and it's about to go on the market, and it's a really, really nice commercial asset and commercial building. But the woman's older. She doesn't have much. She doesn't have much income coming in. She was relying on the tenants to pay the rent. The tenants aren't paying much rent, so she's kind of struggling with things in general. And her current loan is due. She's been making payments on her current loan, but her current loan's due. We'd be coming in still at like a 40 LTV. So LTV wise, we're good, but there's more hair on the deal, right? Like, we don't really like, listen, it's nice to save people from sinking ships. I get that, but this is an investment that you want to invest your cash or capital that you're controlling into. And you got to make sure that capital is going to get repaid. And that's your top priority, is to make sure the capital is getting repaid. You're lending money to investors and sophisticated, commercial property owners. So you want to make sure you're doing it the right way and they have the ability to get out of the loan. So just some good tips, recap from this podcast today. These, make sure you follow all this and you do a little bit more due diligence on there, because again, the exit strategies are typically a little bit hairier on refinances. And, if you got one big thing out of this, you don't want to be an ATM machine. You don't want somebody to come to you and just take out cash from their property that you lend them with no clear way for them to return it.
Yeah. I mean, that's a good takeaway right there to wrap up. Like, there are opportunities in refinances, and you should do some of that volume and have that part of your portfolio, but know the whole story. Get the whole story up front, see what's going on, document it accordingly in terms of exit strategy, what they're doing with the cash, and you'll be good. And you'll be good as long as you're at the right equity position. Even if they do get kind of sideways, you'll be okay as long as that file is complete. So yeah, guys, we appreciate you checking out the podcast, and we will see everyone next time here, Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.